Good morning, ladies and gentlemen. Welcome back to our series of tutorial on commerce, and we discuss various aspects of investments, debts, and financial management, the personal resources. Let's talk about cashing out from tax avoidance. Of course, the legal one, in fact, legal if one can cash out from tax avoidance. Although personal expenditures always require cash outflows, some also have the reverse effect, namely reducing your tax bill and thus uh, saving you some cash for your other uses. Individual retirement accounts (IRA), some education savings accounts, and the transaction involved in buying and selling homes all have this effect. Before you commit any money to these instruments or activities, check with an expert or tax regulations that they change from time to time. The IRA tax break. With a traditional individual retirement account (IRA), you can in effect make a tax deductibility saving deposit up to $3,000 in 2004, up to $4,000 in year 2005 through 2007, 2000 and $5,000 in 2008. The amount ultimately depends on your income level. IRAs are long-term investment intended to provide income at a percentage of 59%, 59 and a half, if you're intending to save for the distant future anyway. An IRA boasts immediate cash advantages over the typical saving account. Why? Because your current taxable income is reduced by an amount of your contribution. Here is how it works. Let's say that you are a qualified employee with a uh, income, federal income tax rate of 20% in year 2005. If you contribute $4,000 to an IRA account and you avoid $800 in income taxes, 0.20 cross multiplied into 4,000 is equal to $800 that you would have owned if you had treated $4,000 as normal income or put it in your standard savings account. Your untaxed contribution and their accumulated earnings will be taxed later when you withdraw your money from IRA account. Why is this tax break? The idea of IRA is based is on the assumption that after you retire you're likely to have less total income and will therefore have to pay less tax on the money withdrawn as income from your IRA. What are the IRA risks? If you take money out of an IRA prematurely, you'll probably get hit with a 10% penalty. This provision poses a financial risk, especially to people who haven't determined whether they can afford IRA investment or they can't. And it is, in fact, aligned with the time requirement. If you can meet up that time requirement, only then you should go for it. Otherwise, you can find your own problems and suddenly you may find yourself in difficulties. One needs to adjust your asset portfolio to conform to your risk and return preferences: conservative, moderate, or aggressive. These are the return preferences, the conservative preferences, moderate preferences, and aggressive preferences. Why buy a life insurance? You can also think of life insurance as a tool for financial preservation. As explained earlier, a life insurance policy is a promise to pay beneficiaries after the death of an insured party. In return, of course, of the insurance companies collect premium payments from the insurance purchaser during his or her lifetime. So one gets the benefits of the life insurance, if not for himself, for his successors. Or then there are other advantages such as medical coverage. This is also one of the greatest of the advances.